Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome my longtime friend and former colleague, David Lee Berkowitz. Thank you, David, for joining me on our Fortuna Advisors podcast, Create More Value.
Thank you for having me on the Create More Value podcast. I'm honored to be here.
Dave, or Berk as we call him, is the founder and chief investment officer of Value Aligned Partners, or VAP, an investment firm he formed in 2002. He is based in New Jersey, and as he says, being away from Wall Street's constant buzz allows us to make decisions based on long-term value rather than short-term market noise. In describing his investment process, he says, "We invest in high-quality companies with durable competitive advantages, often called moats, that consistently generate returns on capital above the cost of capital. And aligning management interests with shareholders is crucial for company success." I know, sounds like me talking, but check out his website. We think a lot alike. At least part of the reason for this is that before Value Aligned Partners, David and I worked together at Stern Stewart implementing EVA, or economic value added, at large companies. Oh, and both his undergraduate economics degree and his MBA were both from Columbia, further reinforcing the value theme. David, when we last spoke, you talked about how all the catering that companies do to please and appease Wall Street is really all quite dysfunctional. Can you explain what you mean by this?
Sure, Greg. Before I do it, I want to set up just a general framework around the idea of how we invest here and how I've been doing it ever since I left Stern Stewart. Basically, the idea that we have is, and I probably learned this at Stern Stewart more than any other place that I had, is that the crucial question in a marketplace, in the stock market in particular, is we always want to know what is discounted. What is discounted? And the idea for us is that market prices reflect the weighted average, the expectations of future results. And then for us, adding value involves forecasting those changes in the long term, I say, expectations. So there's really only three competitive advantages that you can have in the stock market. The first one is an informational advantage. And that's the one that when I worked at the hedge fund, and I see other hedge funds and I see other people try to be day traders or whatnot, they still think that there's a way in these markets to have a good informational advantage. Now, in my view, the only ones in these days that have good informational advantages are the guys that sit on the sell side desks of the big investment banks, because they do have quasi inside information. But when I started back in the late 80s on the trading desk of the first hedge fund I worked for, informational advantages is all we did. That's exactly what we thought we could get. And that was before there were cell phones and before there was an internet even. And information, it took a very, very long time to go from start to finish. So the earnings game back then was really important. We could make a lot of money doing it, but it's still short-term and trading. The second way you can make money and get an advantage in the stock market is an analytical advantage. And that's also been sort of eroded by technology. Certainly informational advantages have been eroded by technology. But I do think that when I was at Stern Stewart, one of my ideas that I came up with was, I think I can get a analytical advantage simply because I've now begun to understand how dysfunctional the focus on earnings per share really was. I mean, I learned it in business school. I learned it, academically. I learned it in my training at Stern Stewart. But until I got to the boardrooms and I actually saw what goes on with the earnings game and the quarterly and annual budgeting process, I was astonished. And to me, I figured that there's a way analytically, if you could identify companies that did did the things that were more aligned, hence my name of my company, that with creating value, that you would have an analytical advantage because people were focusing on the wrong thing, quite frankly, both the short-term earnings, and they were focused on the wrong types of behaviors within the company, which brings me to the third and most important aspect of how you make money in the stock market in 2025 is the behavioral economics. And this is where really I probably learned the most from being at Stern Stewart, understanding that incentives really matter in the real world. And in fact, incentives were everything, both explicit and implicit incentives, both in terms of how a structure is set up, like a budgeting process, for instance, and or how a simple thing like reporting your quarterly earnings to the Wall Street community, and how that focused on and created different predictable behaviors within a corporation. Having said that, it's really simple to understand how the earnings game itself, and let me tell you, I've learned a lot from this book right here.
Thank you for the plug.
Yeah, it's one of the, I got to tell you, Greg, it's one of the best recitations for somebody that's not even, you don't have to be an academic. You have to have a little bit of, you probably had to go to college, but especially that story that you tell at the beginning, I think that was one of the better case studies I've ever written about an EVA implementation. And it reminded me, I forgot the name of the woman that was the head of that company. But anyway, it reminded me of when Mary Barra took over General Motors. And a lot of the changes that she implemented at General Motors, or at least a lot of the outcomes, I wasn't privy to being inside General Motors, but your case study in there was just brilliant, I thought. So everybody ought to read that one.
No, I appreciate that. That's in the prologue, and it's a fictional story, but it's made up based on experiences I had with a lot of different companies over the years. And at some point, probably someday, way in the future when I retire, I'm actually going to try to write a novel with the same theme, that as a business leader facing challenges and how they deal with them as a way of communicating some of this in maybe a little more entertaining way than something that reads more like a textbook. So, but to go back to the what you've said, so companies woo investors by describing their business, but also by giving guidance and talking about what they expect to happen as far as earnings and revenue and EBITDA and share repurchases and capex, so the people can build their models of what they expect EPS to be and that sort of thing. What you've said you think that that's kind of dysfunctional. How is that? Does that have an impact back on how the companies manage? What is the dysfunctionality?
That's what I learned. That's why I wanted to set it up was when we last spoke. We talked about the whole earnings game. Now, the whole earnings game is kind of a well-known phenomenon, but let me tell you, it's still practiced by almost everybody, and it's dysfunctional to the extent that it leads corporations to focus on short-term issues to the detriment of making long-term investments. I could not believe when I first started working with my client companies at Stern Stewart that this was actually true. I knew sort of intellectually that, the company, that all we really care about when I was sitting on a trading desk at a hedge fund was tell me what the expectations were, tell me what they said, tell me what they beat by, what was the whisper number, and all that other stuff. And at that time, I was a trader. I didn't really have enough under my belt to understand what all the flexibility in corporate reporting and GAAP accounting that that C-level executives had to manage. But what ends up happening is guidance seems to them to be everything.
Mm-hmm.
Meeting guidance, or most in these day and age, you have to beat guidance. And that's because that's what the press tells everybody to do. So let's just think about it. What does that mean? Well, what that means is that, oh, geez, if I'm a penny or if I'm 10 cents short, and if I believe that if I miss by 10 cents, that's going to crater my stock price, I might have some incentives that might be vesting soon, or I just have ownership in the stock price, and I have this misbelief that 1 penny or that 10 pennies is going to mean a hell of a lot to the company's stock price, and therein lies the problem. The problem is that the company, he's trying to manage something that can't be managed. I've never seen it managed except maybe with the best, except for the best company, the best traders on Wall Street in the short term. That was the informational advantage that I was talking about. But they still think that that's the way it goes. So they're managing for share price. You can't manage for share price. And that's where I came to, it's fundamentally a problem if their goal is to manage for share price, and they think that short-term share price is a worthy goal. And then they also think that they got to meet or exceed those expectations in the earnings game. And bang, what does that lead to? That leads to cutting R&D, training, all the stuff that for the long term, a great company would never do, for the long term. So that's why I put up your book, is because it's the trade-off between the short and the long term. And in the end, this is the whole ball of wax, so to speak, if you wanted to talk about value management.
Yeah, no, that's really great. And you hit it at the end there. The inside the company, the cutting of R&D projects that last week you thought were a good idea, but now all of a sudden you have to cut them to hit some earnings number, can't possibly be a good idea, right? Those are projects you had thought were positive net present value projects. They created value, and now you're canceling them or delaying them till next year or whatever. It manifests itself in bad internal decisions that deplete the long-term value. So yeah, I think that's all really good.
Yeah, we can call it long-term value, but of course we know that if you were really managing for today's intrinsic value, the moment they cut that stuff, they lowered the intrinsic value of their firm.
Yeah, even if it takes a little time to actually show up. So do you really then avoid the whole short-term earnings game? And if so, like, how do you do that? And what do you pay attention to on an earnings call?
Well, I don't avoid it, except I exploit it. Now, we're quality investors. I'm a long-term value investor. You mentioned that I went to Columbia. That is why I went to Columbia, is because it's where Ben Graham taught Warren Buffett how to be a value investor. So yes, I went back to Columbia Business School just for that focus. So what I don't believe that markets are inherently efficient and that I get too much information about particular companies' valuations from just looking at stock price. And you probably heard me say it like at least 5 times already. The most dysfunctional thing that I believe that happens between CEOs or C-level executives and what they should be doing, that big dichotomy happens to be value, happens to be the concentration on share price and not value and not intrinsic value. But anyway, so first of all, I don't listen to earnings calls. I could care less. Of course, I get with this day and age, I get the press releases. That's it. I see the press releases come across my screens every day, and I'm anticipating that one of my companies that I own a big chunk of is going to be reporting soon. All that matters to me to some extent, but what really matters to me is the stock price reaction. So because my goal, I know these companies very, very well, and I have already determined them to be what we call value line companies. That's sort of like quality companies that have the right type of not just management, but also management systems and a mindset that I'm happy with. So that's where, on a tactical basis, that's where I look to earnings calls so I can get the stock price down so I can buy more. Literally, that's what I use it for. I could care less if they. In fact, I don't like it when my CEOs or my investor relations people talk incessantly about what their guidance is and whatnot. I'd say that out of the 35 companies that we own in the value line model portfolio, fully 1/3 of them have no guidance at all. And I look for that. And then another third just give annual guidance, which again is not really any guidance at all because they're not giving you guidance for every quarter. So people are focusing on that. And then I still have some stragglers, but and they're good companies. But that's one of the distinguishing features of a company that I like to look at. And it's also one of the events that I will look at when I hear, or when now in this day and age, I use AI to find out, or a search engine to find out that a company has decided, like a new CEO comes in and he's not going to give guidance anymore. Well, stock price goes down many, many times when that happens, and I'll be there to scoop up shares.
Well, that's great. That's great. I mean, I generally, I would say there are some special circumstances, but I generally advise against giving guidance. And when you do give guidance, as you say, give it annually, and even better is guide on fundamentals rather than on EPS, and let them build their own model of whatever they want to build.
Right.
So you're talking about volumes and price or mix or something like that. But I agree, and I'm really glad you went there. That's an important message for people to hear.
Yeah, the important message that I also want people to understand is that when you're investing, you're trying to get an edge. You always try to get an edge, and here's a place that you have an edge because it's a completely different analytical framework in your mind. Most of the people out there are saying, "Hey, they missed their guidance, or they're not going to give guidance, so something must be wrong." Well, if you understand why or what happened, you'll understand. It's a signal basically to you to keep going.
So, public company investors, this is what we've been talking about, but how are they different from like private equity investors? What are the real differences in the way they behave and the way they look at the companies they own?
One thing about public company investors is that they're not all the same, right? They're not all the same, but I could say that you have one side, which is the equity hedge fund trading type. And that's a big chunk of money nowadays. When I first started, there was a handful of us. There was my company, there was George Soros, there was Julian Robinson. What we did was we met our investors into our funds were individuals. They weren't institutions. Nowadays, you get institutions that go into hedge funds, but still the hedge funds are still in the analytical and information game themselves. Unfortunately, you see it from time to time. Those guys get on bordering. So you have those guys. Then you have what's the bulk of the institutional market. I call them an institutional market, but that's basically the mutual fund apparatus. So you have big mutual fund managers, and there's a lot of them, and there's many of them. And they're the ones that have the big analyst departments, and they're putting out, their job is basically to market. I've come to that conclusion. And so they do a lot of stuff that says a lot of things, but they're trying to attract either investment advisors so that they put their people in their funds, or they're trying to attract just individuals. So there's this whole host of trillions and trillions of dollars of mutual fund companies and mutual fund managers, and they're really an odd lot, right? Because what are their incentives? Their incentives are basically they have really good jobs. They have teams of analysts that do a lot of the work for you. In this day and age, they don't even have to write that well because now we have ChatGPT and all the other AI models.
Mm-hmm.
So their jobs are getting very, very productive. But the one incentive that they have is not to get fired.
Mm-hmm.
And because they don't get fired, because they have that incentive, they all do pretty much the same thing.
Right.
So you can look at a growth equity growth equity fund, and they'll have a lot of the same names all the time. Same thing with the mutual fund. I mean, with the hedge funds, they'll have all the same names.
Mm-hmm.
And so that leads to a lot of short-termism and a lot of short-termism and a lot of the earnings game coming from those type of investors.
Mm-hmm.
Then you have the third kind, which is the kind I like. That's the kind I like, is the long-term institutional investor. These are pension funds that aren't going to pull their money because you missed 2 quarters in a row of your benchmark. They're not investment advisors that put their clients into the mutual funds, so they're not going to pull investments because 1 quarter Tesla's down 35%, but you're going great guns because you think that stock's going to quadruple in the next 4 years or whatever.
Mm-hmm.
But those guys are able to have very, very long-term horizons. And then there's a fourth group of public company investors who are a very small group of people. It's what Joel Greenblatt, he wrote a book, and he famously says it's one of the books that I think sold 6 copies or something. I can't remember what he said. But to me, it was a great book. It was an eye-opening book because it was a book that said that the one group in the public markets that have an advantage are individuals or advisors to individuals that don't play all this other stuff, that really truly are long-term. Okay, so that's public investors. It's not a homogeneous group, but for the most part, public investors are short-term orientated. They have to trade a lot because they have to get soft dollars to help them with their budgets, and that's it. So that's what the public equity. Oh, and I did forget. I'm sorry, I forgot activist investors, which one of the great podcasts that you did, Greg, was with is his name in Wellman?
Glenn Welling, yeah.
Welling, okay.
Engaged Capital, yeah.
Yeah, that's one of the great ones. So what I left out was activist investors. Mm-hmm. Now, activist investors, there's a whole slew of types of activist investors, but the ones that are private equity-like in what they do to the companies, mm-hmm. they're the mm-hmm. ones that are very similar to private equity investors in the sense that they're there to make a buck, but the good ones are there for truly transformative management. In fact, way back when I first left Stern Stewart, I had it in my head that I was going to combine consulting with investing, which is basically the activist model, and I was going to somehow go tell companies that I can help them improve by implementing EVA, for instance. Mm. But that's what a good activist investor does. Good activist investor sees a company that maybe it was founder-led, and then they come in, they can change incentives, or they try to. Now, they're limited because they're minority shareholders still, and they are in a public company, and there's other shareholders they got to worry about. But the good ones come in with good plans, and they stick around, and the companies improve. And that's one of the great ways that I have found over the last 20 years since I've been doing this at my company, is one of the great ways is to say, hey, if an activist investor that's on my list of these guys are good, it announces that they're in a company, that company immediately becomes, top priority for us. So then we start looking, why are they there? What could they possibly do? Because the gains that could be made in the market are great. And as you can see, a lot of the stuff that I do is understanding the signals that create. So there it is. I got an activist investor in the private market, which leads me now to the private equity side of the business. Mm-hmm. And of course, these are companies that, these are firms that buy whole companies, and they'll take them private. I'll leave aside the venture capital side of private equity. And the private equities that we're talking about are like Wellings Group, like before that, relational capital. That's the idea that I had. I got it from relational capital. They had a fund called the Catalyst Fund. But anyway, so those private equity funds, what they do is they see something where there's a whole bunch of opportunity. There could be a whole reasons why they think that there's opportunity for them to, load on some debt, take the company private from the public markets. Then once they're private, and this is the funny thing, because of the earnings game, right? Because of all the short-term starvation of innovation spending. And one of the things that I didn't mention that's very important in this day and age, Greg, is that sales and marketing expenses are so important to everybody because they're measurable now with digital media and whatnot. In the old days, you could cut that and you could have sort of the quasi excuse that says, well, I'm going to cut it. I'm really doing it to meet my earnings number, but I'm going to cut it because, I never know which half, what the famous quote, never know which half of the spending is the one I get a good return on. And we're not in that mode anymore. So a real competitive advantage that you see in so many companies, especially companies that have products now that they need to sell, is you don't want them to cut those two things. Okay, so we've had a class of, I've talked about a class of P&L expenses that their earnings game makes you cut. Well, the private equity firm comes in and saves the day. What do? They take you private. They load up with a bunch of debt, which is a disciplinarian, which means that now the cost of capital is explicit because so much of the capital structure is in debt, and that really culls the mind. And these guys are basically what we did at Stern Stewart. We tried very hard to implement value-based system, both in terms of incentives, in terms of measurement, in terms of the budgeting processes and strategic processes. I'm talking to the choir, but but the whole point is that they come in and they are able to do those things because they now own the company. Now there could be outside investors, but they own the company, and their goal, the way they make money, is they're not quote unquote long-term investors, meaning they're going to be there forever, as Warren Buffett would say. No, they got an exit strategy because they got a fund that put the money in, so they want to go 5-7 years, something like that. But they do a great job. And the fundamental difference, taking away the activist investor part, the fundamental difference we get back to is short-term versus long-term. The whole money management game, the mutual fund complex, that whole idea is a dysfunctional job. So I would say that the public investor, with their turnover rates of 9 months to 1 year, still is just unbelievable. And the private equity guys are guys that really are in there that, in my mind, they implement value management systems.
Yeah, I think that's great. I think one of the things I think about with a PE firm buys a company and they're hoping to improve it, run it for a while, and then, of course, sell it, either bring it public or sell it to another PE firm. And so, when they buy the company, what happens next quarter really doesn't matter. What happens at an end point, let's say 5 years from now, sometimes longer, sometimes shorter. And so, they're much more willing to make investments and do things that are going to take some time to pay off, because the D-Day is really that 5-year day. And it leads me to something I often ask CFOs when I first meet them. Would you be willing to do something that's likely to be misinterpreted by the stock market and watch your share price drop 10 or 20%. If you were so convinced that it was the right thing to do, and you expected that, let's say 2 years from now, your share price would be 20% higher than it otherwise would have been, but it's going to take time to get there. They're going to wait to have to see the results of this initiative, and it's going to take time to pay off. Would you be willing to do that? And it's very obvious from the research that some, professors have done that most companies are not willing to do that. Right? They very clearly don't want to take actions that take time to pay off, and that is what creates the opportunity for both the private equity firms, and the activists. I think is that vacuum, creates an opportunity.
It's one of the reasons why that type of investing and investor are the ones that really can outperform, like outperforming matters, but they're the ones that, for lack of a better term, make the most money.
Yeah. Well, so when you look at the landscape of companies, there are a few different buckets of companies that you like to invest in. Mm-hmm. What are those different buckets?
Well, the way the buckets have come down through the years is, let me first start with, we have a universe of companies, and most of our companies are at least traded in the United States. And I have a universe of companies that what we do is, there's a certain type of company like a utility that we just don't worry about. We're thinking about changing that because of the AI explosion in energy demand. So we might be rethinking some of those things. But the point is that there's certain types of companies, certain types of industries that we just leave out. It's not part of our circle of competence, as Warren would say. But so I would say it's like take the Russell 3000, take out a few of the companies, and only look at the companies that are $250 million or $500 billion and greater. It used to be $250 million, but market's up so much since I first started. Now it's really de facto a half a billion. And I take a look at those companies, and I look for signals to see which ones might be value aligned. And those are all the signals that I've talked about. Things like, do they have an activist investor in there? Are they a public company, but they still have the private equity fund with a very large stake and people on the board, for instance? These are all things that you can find out, as you're doing things. Also, there's, and I look at to see, I'm not looking for the next big thing necessarily. I'm looking for the great company that's going to continue to compound because they have a very high rate of return on capital, or better said, a higher incremental rate of return on capital. And they're just going to compound and compound. I'm looking for something that I can own forever going forward. So we take a look at the 3,000 companies, and it's been pretty consistent. I would only say that somewhere between 8 and 10% of those 3,000 companies actually qualify as being managed for value, meaning they don't necessarily play the earnings game. They understand the earning. They don't manage stock price more than they manage for value, or for long-term value, as some of us call it. So I always have a list of about 300 companies, and then I cull that down. Okay, I cull that list down into the top 10% of companies that are, I don't know which metric to call it, but basically the top 10 performance-based companies that are performance-based on a grid versus valuation metric. Mm-hmm. So they're, out of those 3,000, if I get, I'm looking for the top 10%. So I'm looking for 300 companies from there. And they become my list from which we start doing our work. Mm-hmm. And then, as you mentioned, there's 3 buckets. And those 3 buckets come from all these different signals that I've sort of learned over the years. And if I can put them in those buckets, there's a high likelihood that I can be rest assured that there's going to be there's going to be a company there that is practicing the kind of value management that I think that will give me large rate of returns and compounding over time. Anyway, so those three buckets are, the first bucket is ownership companies. I call them ownership companies, but there's really different types of ownership companies. A lot of research has been done over time. I've seen it with my own eyes. You've seen it with your own eyes. But companies that have ownership, implicit and explicit incentives throughout their organizations are companies that outperform over time. And these can be, the first ones that are natural to use are family-led companies that are still led by, somebody in the family. I've got quite a few of those in my portfolio. And some of them are really large companies like LVMH, or some of them are really tiny companies like IBP, which is an install building products, which is a company that is a roll-up of a bunch of local guys that install insulation, believe it or not. And that company is just a phenomenal company. It's Midwest. But again, the reason why it was on the list, he got into that bucket, and it's a small company, but he got into that bucket. So that's the first one. It's ownership companies. We call them ownership. Those are the ones that are likely to have ownership incentives. The second one, I call it the Pac-Man company, but everybody calls it the cannibals. And the reason why they call it the cannibals is because Charlie Munger called them the cannibals. He goes, watch out for the cannibals. Those are the companies that you should be targeting. Why? What does that mean? These are companies that are eating themselves by just year after year after year. They are basically doing a inside leverage or management buyout by using the cash flows from the company to buy back stock. And over time, those are the companies that we invest. We have a lot of those companies in my portfolio. One of the greatest examples of that from when I went from Stern Stewart to being a stock picker again was AutoZone. I didn't know that AutoZone, did all this, but AutoZone turns out that Wall Street hated AutoZone. It was losing market share. They never keep up. They didn't know anything. But the one thing that AutoZone did was they said, screw the earnings game. They don't give guidance, haven't given guidance for the 20 some odd years. They have two basically metrics that they go for. They go for return on capital, but not by itself. They also have some other flow metric in there that they think kind of mitigates it, but we know that they could just get rid of it and just do something else. But the fact of the matter is that they've been a prodigious. When I first invested in the company back in 2002, from till now, I think their share counts are down 75%.
Wow, that's a lot.
And so that's one, and there's a whole bunch of other ones. Now, it's not companies that are willy-nilly about buying. Everybody buys back stock, and so much of it, which I know, I read your work. You've done such great work on this, that so much of the buybacks are for the hell of it, for the equity incentives to manage dilution. They buy it at the wrong price. But usually when you find these guys are opportunistic buyers, meaning that they don't just have a program, and that their incentives aren't, structured to where it's important for them to have, what they would consider to be a short-term price bump. They certainly don't buy these things for short-term price bumps. AutoZone's a great example. McKesson's another great example of that. Just a wonderful. So that's the second bucket. And the third bucket is just companies that are oligopolies or monopolies. These are companies that just dominate their interest. And thank God I have that bucket, because these are the companies that, these are like the Magnificent Seven stocks. So I've owned Google forever. I've owned Microsoft forever, and these are companies but now across the spectrum, what all these companies have is they have very high and consistent returns on tangible capital, because they're the ones that are going to most likely be the ones that are going to be able to reinvest, have the opportunities, and compound out at, 2 or 3 times, or 2.5 times. There's not many that go 3 times, but about 2 to 2.5 times the market's long-term 10% average. That's why we're there. So owning Taiwan Semiconductor for me, which just happens to be one of the owner companies, but it's so big. Google's an owner company too, but it's so big. Microsoft, those companies, by owning those companies, saved me. And then companies that used to be smaller and fell into the other 2 buckets have since become dominant. One of those is, you probably remember from our Stern Stewart days, Thermo Fisher.
Thermo Fisher, yeah.
Thermo Fisher, started out by, a smaller company with a lot of the right incentives, and changed into a dominant company.
Yeah. No, it's a great case example. We're running short on time, so I'm going to ask you one more question because I think it's important to kind of close the loop.
See, I still talk a lot.
We've talked a lot about like the characteristics of companies and the way you look at them to think about them as investments and so forth. But you also look at the operating systems they use inside the companies. And, what do you look for? And how do you, sitting outside the company as an investor, how do you actually learn how they manage internally? And how do you figure out what's real versus what's just like spin?
Yeah, it's a great question. When we first started, when I made the leap from Stern Stewart and came here, one of our partners, Mark Hodak, worked with me on creating little scorecards that we could put companies through from the outside in. So the whole idea was let's see if we can grade, if you will. Every company would get a grade on how value aligned they were, and that would be basically along the 4 dimensions that we always talk about, whether they had focused metrics, whether incentives were tied to those focused metrics, what they were they value based, were the incentives structured to where they would go, to structure to where we would think that was a right way, to encourage the right kinds of behavior. And then in management processes, the big one is one that you always harped on with me, and it's made so much damn sense, was just the internal budgeting process, which when I first got into these companies, I could not believe how they do this stuff, how dysfunctional it could be, and how could these smart MBAs and engineers, how could they not, the guys at the top, how could they not understand that when you let somebody negotiate what their budget targets are, that it's inevitable that everybody's going to underperform.
Yeah. Right.
And the potential, I never could get that. Now, a lot of times over the years, I've tried so hard from the outside in, I'm a little guy, so it's not easy so you have to do a lot of reading to find out how they do things. And there's very few companies that do it, the right way, where you zero-based budgeting and every year where it is. But there's companies that do it a better way, and there's a company, and then there's actions that come out of that. And so I get to ask questions, or I get to read their earnings calls. You asked me earlier what I look at. I look at that stuff. I want to know what happened to the project that they talked about 2 quarters ago, and now all of a sudden I don't hear anything about it. What happened? And, those are the kind of things. And then I hear stuff like, we missed our EPS because the bonuses were high. So then that gives me the open to find out, how were those targets set? What do you mean they were high? And, everybody else is selling the stock because you're paying bonuses out. But, if the structure's right and I see that they're paying bonuses out, give a if they missed their EPS targets, especially if they gave out incentives, that kind of shit. So yeah, we take a look at best practices, and it all stemmed from I don't know if you remember, Greg, but you remember Bennett's shareholder alignment index? Well, I was a little part of that, during the last couple of years, and Mark Hodak was too. Mark Hodak did all the analytical work, and so I was part of that. And I said, "Well, geez, I always thought to myself, if I could identify companies that were either changing into value-based companies, or changing into EVA companies, or I knew that, they were there. I always wanted to be one of the guys that shared in the Herman Miller options, for instance. I said, that's the way to go. That's the way to do these things. The way to do this is, these people have best practices, and if they're going to go to the best practices, then eventually it'll show up in the stock price. So that's how I did it, and I still do it that way.
That's great. All right, I'm going to wrap up here. So we've been speaking with David Berkowitz. Thank you, David, for joining us for this important conversation.
Thank you, Greg. I enjoyed it.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.